Have you ever found yourself lost in thought, pondering the secret to saving money on dividend investing? If so, consider this your lucky day. In this day and age, investing can be a daunting task, especially when it comes to navigating the world of dividends. The financial landscape is filled with complexities, and it often feels like you're trying to solve a puzzle with missing pieces. However, fear not. Knowledge is power, and understanding how to effectively invest in dividends can be the difference between a fruitful financial future and a dismal one. Today, we are setting sail on an enlightening journey, a voyage to explore the enigma of dividend investing. We will delve deep, past the surface-level information you can find anywhere, into the heart of effective investing strategies. We are not just scratching the surface here, we are going deep, uncovering the strategic layers that often go unnoticed by the casual investor. We're breaking down the complexities, simplifying the process, and shedding light on the crucial aspects that can truly make a difference to your financial health. Our mission is to provide you with 8 essential tips, a treasure trove of knowledge that has the potential to revolutionize your approach to dividend investing. These are not your everyday tips. These are the power tools that can help make your dividend investing journey more fruitful. Tip number 1. Diversify your investments. This is the golden rule of any financial endeavor. The principle is straightforward, but the execution requires thought and planning. When we say diversify, we mean don't limit yourself to just one type of investment. Broaden your horizons. Consider stocks, bonds, real estate, and even commodities. Each of these options has its respective opportunities and risks. And remember, it's not just about diversifying across different types of investments, but also within them. For instance, if investing in stocks, don't just pour your money into one industry or one company. Spread it across various sectors and companies. This practice not only curbs the potential losses, but also optimizes your chances of yielding higher returns. It's akin to not putting all your eggs in one basket. Spreading your investments across various sectors reduces risk and offers better opportunities for return. Tip number 2, reinvest your dividends. It's an incredibly simple yet profound concept. Let's delve into it a bit. Consider for a moment the power of a tiny seed. It may not seem like much, but given time and the right conditions, it can grow into something magnificent, such as an enormous tree or a field of beautiful flowers. And your dividends? They are much the same. Just as you would plant a seed into the soil, so too should you plant your dividends back into your investments. Right now, they might seem small, insignificant even, but don't let their size fool you. Just like seeds, dividends have immense potential for growth. Picture this. Every time you receive a dividend, you take that money and reinvest it back into your investments. This money then starts to earn its own dividends, which you then reinvest again. Over time, this process compounds, which means not only your initial investment is growing, but also the dividends it's generating are growing as well. Now, this method of planting the seeds of wealth doesn't guarantee overnight success. It's a long-term strategy, one that requires patience and persistence. It may take years, even decades, for these seeds to grow into a towering tree of wealth. But imagine the satisfaction of watching your wealth grow, blossom, and bear fruit, all because of the seeds you planted today. So let's cultivate a mindset of patience and persistence. Let's nurture our investments, providing them with the necessary care and attention they require to grow. And remember, this growth doesn't happen in a day or a week. It happens over time, gradually, almost imperceptibly at first, but then more noticeably as the years go by. That's the power of reinvesting your dividends. Think of your dividends as seeds. Plant them back into your investments and watch your wealth grow over time. Tip number 3, go for dividend growth stocks. These types of stocks are a category of their own in the investment market, and for good reason. Dividend growth stocks are primarily offered by companies that have a proven track record of not just maintaining, but consistently increasing their dividends over a period of time. This represents a unique and attractive feature for investors, as this increment is typically reflective of the company's stability and growth. While investing always carries a certain level of risk, dividend growth stocks are often considered to be a safer bet compared to other types of stocks. Their steady increase in dividends often indicates a company's success and financial health over the years. This not only provides a reliable source of income, but also offers potential for capital appreciation. However, it's crucial to remember that not all companies can increase their dividends on a regular basis. This is usually because they might be channeling their profits back into the business to fuel expansion or to cover operating expenses. Therefore, when investing in dividend growth stocks, it is always advisable to do thorough research to understand the company's history, current financial standing, and future prospects. The dividends offered by these stocks can be reinvested to purchase more shares, thus creating a compounding effect and accelerating the growth of your investment. Therefore, dividend growth stocks can be a significant part of your investment strategy if you are looking for steady income, along with potential for growth. They're the golden geese of the investing world. Tip number 4, understand the payout ratio. This is a pivotal concept, a financial metric that is widely used in the world of business and investing. The payout ratio, in essence, refers to the proportion of a corporation's earnings that it decides to distribute to its shareholders in the form of dividends. It's quite interesting how this single percentage can unravel so much about a company's financial health and its future prospects. This percentage, calculated by dividing the total dividends paid by the net income of the company, holds immense significance. It throws light on how much the company retains from its earnings, setting it on the path of reinvestment and growth, versus how much it deems appropriate to distribute among its shareholders. A higher percentage might be appealing at first glance, as shareholders may receive a substantial share of the profits. However, a high payout ratio could be a double-edged sword. On one side, it could indicate that the company is generous in sharing its profits, which particularly attracts those who invest for regular income. On the other side, it could imply that the company isn't plowing back enough profits into its operations, thereby potentially hampering its growth. Deciphering this delicate balance is vital. A high payout ratio could indicate that the company is giving away too much, leaving little for growth. Tip number 5, invest in tax-efficient accounts. What does this mean, you may ask? Well, let me elaborate. In the world of finance and investments, there are certain vehicles that are designed to be beneficial in a tax perspective. These are known as tax-efficient accounts. They're specially structured to help you save money on taxes that come from your investments. Let's delve a little deeper. There are numerous types of these accounts, each with its own unique benefits. For example, some accounts offer tax deferrals on capital gains, while others offer tax-free withdrawals in retirement. However, for today's tip, we're focusing on those accounts that offer tax advantages for dividend income. Dividend income is a portion of a company's earnings that are paid out to its shareholders. This income is usually taxable, but with tax-efficient accounts, you can reduce the amount of tax you pay on it. It's not about how much money you make, but how much you get to keep. And these tax-efficient accounts can dramatically increase the amount of your earnings you get to keep. Remember, investing is not just about making money, it's also about smartly managing it. And choosing the right accounts to invest your earnings can make a significant difference in your financial future. So, if you're someone who receives a decent amount of dividend income, it would be wise to consider investing in a tax-efficient account. This strategic move can save you a good chunk of your earnings. Tip number 6, avoid chasing high yields. High-yield stocks might seem attractive, but they often come with higher risks. Instead, aim for a balanced portfolio with a mix of yield and growth. Tip number 7, keep a long-term perspective. Dividend investing isn't about making a quick buck. It's about building sustainable wealth over time. Patience is key here. And finally, tip number 8, stay informed. Keep up to date with market trends and financial news. Knowledge is power, especially in the world of investing. In summary, diversify your investments, reinvest your dividends, go for dividend growth stocks, understand the payout ratio, invest in tax-efficient accounts, avoid chasing high yields, keep a long-term perspective, and stay informed. Remember, these tips are not just advice, they're a roadmap to a successful dividend investing journey. Apply them and watch your wealth grow. And before we wrap up, if you've enjoyed this video and found the content valuable, don't forget to give it a like and subscribe to our channel. Your support means a lot to us. Stay tuned for more insightful content. We're signing off now. Keep investing wisely and remember, your financial future is in your hands.